There's a global tax arms race happening right now, and most people don't even realize it. Countries are competing for your tax residency, and the offers are getting more and more aggressive each year. First, it was Panama, then Dubai changed the game, and a few days ago, Turkey just raised the bar again with a 20-year tax holiday on foreign income. So if you got any flexibility on where to live, this is the most important update of 2026 for you. In this video, I'm going to walk you through three things. First, the arms race timeline, Panama, Dubai, and Turkey, and what each one actually offers. Second, what Turkey just put on the table and who qualifies. And third, three questions you need to ask yourself before you pick any of them. Quick context on me, I'm a CPA, I run an international tax firm. We've been doing this for 15 years, and I've personally helped clients move to every country on this list. So when I tell you which one fits which type of person, it's coming from real client situations, not Twitter speculation. All right, number one, let's talk about the arms race, because you can't understand why Turkey matters until you understand how we got here. So it started with Panama. Panama opened up the door years ago with something called territorial taxation, which means Panama only taxes income earned inside of Panama. The foreign source income generally isn't taxed. So we set up a structure in a place like BVI, have your operations run through there, pay a salary to the Panama residents, and boom, tax optimized. You get residency to programs like the Pensionado or the Friendly Nations visa. And for digital nomads or remote workers, Panama was the original OG easy answer. And it still works for a lot of people. Then Dubai escalated it. The UAE charges no personal income tax at all. Not territorial, not residency based, none. You set up a residence through a free zone company or an investor visa. You spend the time on the ground to qualify, and your personal income tax rate is zero. That changed the conversation entirely. Dubai pulled founders, traders, high earners who used to default to Singapore or Hong Kong. And now in between, there have been countries such as Portugal with the 10-year NHR program, or Italy with a flat tax regime for 15 years, but nothing has shown to be compelling and for longer periods of time. And here's the thing. For a long time, that was the top of the market. Dubai was the answer until last week, because what Turkey just announced makes Dubai look short-term by comparison. Now, here's what's actually in the proposal. So on April 24, 2026, President Erdogan announced the tax package, and the headline measure was the one that matters here. If you haven't been a Turkish tax resident for the past 3 years and you choose to relocate to Turkey, you pay no Turkish tax on your foreign source income or capital gains for 20 years, plus a flat 1% inheritance and gift tax for those individuals. And there might even be more tax incentives coming on the corporate side based on rumors I've been hearing. 20 years. That's the part you need to sit with for a second. Most incentive programs are 5 or 10 years. Turkey just offered a 20-year fixed runway in a country of 85 million people with a real financial center in Istanbul. That's a different kind of offer. And it works really well with the Citizenship by Investment program they have, where you can buy a piece of real estate for $400,000 and live in it while you pay no tax and get the citizenship. Now, here's the part you need to hear before you book a flight. This is a proposal. The bill has not been submitted to Parliament yet, and Erdogan did not give a date for submission. So while this is real and very serious, we're watching a proposal move through the political process, not a law that you can rely on today. So for anyone making a planning decision right now, that distinction matters. So now you're looking at three real options: Panama, Dubai, Turkey. And picking the wrong one for your situation cost you years and tens of thousands of dollars. So let's talk about how to actually decide. Before you chase any of these programs, you need to ask yourself three questions. Question one, how much time can you actually spend there? This is where most plans fall apart. Every one of these programs has a residency test. Panama wants real ties to the country. Dubai wants you on the ground long enough to defend your residency, and Turkey's proposal will have its own qualification window once the law is finalized. It's probably 183 days, but who knows, it could be 2 months like Cyprus. I've had clients fly to Dubai twice a year, stamp the passport, and assume they're tax residents. They aren't. Tax residency is about where your life actually is, where you sleep, where your family is located, where your bank accounts are, where your doctors are. A piece of paper for any of these countries doesn't protect you if you're really living somewhere else. Question two, What passport do you hold? This is the single biggest filter, and it's one that most people skip. If you hold a US passport or US green card, you owe US tax on your worldwide income, no matter where you live. That's citizenship-based taxation, and the US is one of only 2 countries in the earth that does it. And it doesn't matter if Turkey gives you a 20-year tax exemption. The IRS still wants its return. Now, there are some real tools that can help. You have the foreign earned income exclusion, lets you exclude around $130,000 of earned income in 2026. If you qualify, that's Form 2555. There are foreign tax credits, there's treaty positions, there's real planning that you could do. But one tool that doesn't help in a country like Turkey or Dubai is the foreign tax credit. Because if Turkey charges you nothing, there's no foreign tax or credit. So for Americans, a zero tax country is not the same as a low US tax outcome. For non-Americans, it usually is. Question 3. What's the long-term plan? Panama is permanent. Once you're in, you're in. Dubai is annual. You renew, you maintain ties. It keeps on working. Turkey's proposal, if it passes, locks in 20 years, which is a serious runway for someone building a business or planning a family. These are very different commitment profiles, and the right answer depends on whether you're optimizing for the next 2 years, the next 10, or the rest of your life. This is the work nobody on YouTube actually does for you. Picking a country is easy. Picking a country that fits your passport, your timeline, your business, that's what actually saves you money. So here's the picture. Panama opened the door with territorial taxation. Dubai raised the bar with 0% personal income tax. And Turkey just put a 20-year proposal on the table that, if passes, becomes one of the most aggressive offers in the world. For digital nomads and founders with real flexibility, this is one of the best menu options we've had. And for Americans, the menu's still the same, but the math is slightly different. Strategy has to account for the IRS first. These countries are competing for you. Use that, but pick based on your situation, not on whichever headline is loudest this week. So if you have any tax questions or want any residency help for Panama, Dubai, soon to be Turkey, any other places, then reach out to us at the link below. And now you understand why this Turkey announcement is bigger than just one country's tax law, but there's a related question I get from clients almost every week. If you're actually going to make a move like this, what's the right business structure to do it with? Is it an LLC, a foreign company, a trust? Picking wrong here can cost you more than picking the wrong country. I broke it down in a separate video. It's on the screen now. Watch that one next.